Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to the CNBC-TV18 special. I'm Shireen Bhan and we're coming to you live from the JPMorgan India Investment Summit in conversation with Jamie Dimon. Jamie, always a pleasure. Thanks very much for joining us here on CNBC-TV18. Since you're here in India, let me start
happy to be here, yeah.
Let me start by asking you about India. You've had a conversation with policymakers, you've spoken with corporate leaders here in India. What's the sense that you get about the India story, a story that you've been a long-term believer in?
You know, when I come to India, very often I see that people are a little depressed about something like that. You're going at 8%. The government has made tremendous progress, and I give full credit to your Prime Minister with the GST, infrastructure, benefits transfers, all the things that are making the economy grow better. And of course, you have a very vibrant entrepreneurial sector, corporate sector, et cetera. So we're quite optimistic of the long-term growth of India and pay a lot less attention to what happens to the rupee today.
Okay, I get that you're not paying that much attention to what's happening with the rupee. But speaking of the macros, and I know it's probably unfair to sort of bunch all emerging markets into the same basket because it's not a homogeneous group of countries or economies. But what would concern you with respect to the emerging market story today?
Yeah, I'm not really concerned. You know, you have, first of all, put Turkey and Argentina aside, where I think you have very serious issues. The rest of the emerging markets are actually doing quite well. And, you know, America's gotten stronger, the dollar's gotten stronger, but that's actually good for the world. The world is actually growing quite healthily. And so the emerging markets are going, it's just more like a teething pain. And you're absolutely right, they're not all the same. I don't even think they should be called emerging markets anymore, to tell the truth.
So how would India stack up in this so-called emerging market or developing economy basket today?
Well, it is the fastest growing economy on the planet. And the government's taking all the things that will make it grow better. It's got an education system, and the national highway system. You're reducing corruption. You're fixing some of the banking problems in the non-performing sector. You change the bankruptcy laws. These are hard things to do. You know, you travel around the world, you see governments who are unable to do that. And, you know, it really does hamper their economies, and this government's been very forceful in getting those things done. Like I said, you have a government doing the right things. You know, I met with some entrepreneurs yesterday. They're doing some fabulous stuff here. I mean, growing businesses and trying to find new ways to do things in the new economy, which will help India, too, quite a bit.
One of the concerns when we speak of fund flow specifically is what happens in a post-QE world. And that, I think, is weighing on market sentiment specifically. How do you read that?
Yeah, well, look, that's a valid concern. I mean, we had this global QE. It's being reversed in the United States. It'll eventually be reversed elsewhere. But you also have the why and the what. You know, if we're growing strong and we're raising rates and reversing QE, that's actually, I think, going to be fine. Yeah. You know, if it has to be reversed in a much faster way, if America has inflation, then you can see central banks doing things that we won't like and that people get a little bit concerned about. But in and of itself, the world's growing, and reversing QE is the right thing to do. Normalizing interest rates is the right thing to do.
Well, speaking of interest rates and normalizing interest rates and withdrawal of the QE, what does the yield curve look like as far as the U.S. is concerned, to your mind?
Yeah, look, I'm not worried about it. I think people, again, are overestimating the importance of the yield curve. And the 10 years over 3% now, you know, it really, in effect, in my view, should be closer to 4% today in a normalized world. We do have 2% inflation. So again, I look at the underlying. If the growth is good and the Fed is normalizing rates and raising rates, that's a good thing. If they had to do it because of high inflation, that's okay. That's a little bit more recessionary.
But speaking of the wild cards, and I'll use that term, which has been used in one of your JPMorgan reports, you know, you've been concerned about the trade war that's currently underway between the U.S. and China. We've seen another bunch of retaliatory tariffs being imposed. The markets so far have shrugged this off. What do you make of that?
Yeah, because it's not a trade war. I call it a trade skirmish.
Is it still a skirmish?
Yes. The American government and our president is right to raise the issues particularly about China. We would like to see a NAFTA deal done. You know, the strategy you go about fixing it is a little bit different, and I may have used a different strategy. It's unclear where we're going to get to. But if you look at tariffs on $200 billion, okay, so just make believe it all got passed on to American consumers. They have to pay another $20 billion, something like that. It's a $20 trillion economy. So the actual economic effect is not dramatic. There is an effect on the psyche, the mind, as the trade skirmish become a trade war. Right now, it's just trade tit for tat, and hopefully we'll get to resolution. I don't expect a trade war. But I also don't expect any progress before elections. So I think you have to wait after November to see if we make real progress.
So what do you then expect?
But a trade war
would reverse
Oh, more countries get involved. If people start to put more barriers up, and you can seriously affect people's psyche, confidence. People stop investing money because they're not sure about where they should invest money. Right now, it's a bunch of skirmishes that hopefully lead to a good outcome. I would worry about it because I think it could offset some of the positives we had from regulatory reform, tax reform, and other pro-business policies.
But what would you expect as being the next leg, so to speak, of this trade skirmish, as you called it? Because we had Wilbur Ross on CNBC say that China perhaps doesn't have too much ammunition left. The Chinese responding, saying that, look, we have sufficient tools to take on the U.S. So what would you then expect in terms of the next steps, the next measures?
I don't know. I mean, again, you're asking, we can raise tariffs more, we can add tariffs to more things, the Chinese will retaliate in other ways, and I don't think all that's good. It's not a devastating thing. Okay, it's not a war. It's a trade skirmish that can have negative economic effects, all things being equal.
You know, 10 years of Lehman, and you have categorically stated that you don't believe the next financial crisis is going to be linked to the banking system because enough checks and balances are in place. JPMorgan says that by 2020 we could expect another financial crisis. Where do you see the vulnerabilities today?
Yeah, I would say not say financial crisis. You're going to have another recession one day, and that will cause problems in financial markets. That's a given. A financial crisis, we had panic, and people weren't they weren't lending to corporations anymore, lending to individuals anymore, and so that was slightly different. The banking system is very sound. In fact, I think I always tell the regulators they'd be taking a victory lap. Lehman wouldn't happen today. Lehman would have had 2.5 times as much equity capital, 2.5 times as much debt, 2.5 times as much liquidity. The regulators had the legal authority to take it over and have an orderly unwind. It wouldn't happen today. So banks in the United States, more capital, more liquidity, more transparency. All the loans, most of the loans that put on the balance sheet are pristine. Losses will go up or down based on a recession. But if you ask what are the things, well, I think trade is a little bit of a negative. QE is a question mark. Obviously you should be concerned about that, but it won't be a banking crisis.
So where do you believe that we find ourselves most vulnerable today? If you believe that the banking system is much more secure in comparison to 2008?
I think the most biggest vulnerability is cyber. Just for everybody. I think that we have to focus on it. I think regulators have to focus on it. I think the United States government has to focus on it. I think we have to make sure, because cyber terrorists and cyber countries, and that they can cause real damage. And we're already spending a lot of money, and JPMorgan is quite secure, but we should really worry about that. Electrical grids, airplanes, financial systems, clearinghouses. I would put that as the highest risk. And that can obviously
so that would be the #1 risk on your dashboard?
Yes.
Yeah? What would the other 2 and 3 be?
The 2 would be if inflation goes higher in the United States and the Fed has to react a little more aggressively in raising rates. I would put that more in the category of a traditional raising rates, which can cause a traditional recession. And you're going to have one day, and obviously that will filter back into financial markets, but hopefully it's just a modest, mild recession.
I go back to my question on how the equity markets in the U.S. have pretty much shrugged off concerns on the trade front, and you believe that's because it still is a skirmish and not a full-blown war, and you believe that it won't escalate into a full-blown war. But what do you see in terms of momentum? Do you believe that the bull run that we've been in the midst of has more legs, has more steam? I mean, people have been writing premature obituaries of the bull run for a while now.
Well, yeah, but the United States grew 20% over 10 years. It really should have been closer to 40. And some of these new policies are accelerating growth. So in some ways, the recovery is long. It's anemic. It's getting stronger. People are coming back to the workforce. The financial system is in great shape. Housing is in short supply. Confidence is very high. So I don't really see the potholes. Like I said, there'll be a recession one day, but I don't see the immediate potholes. So if you postulate there's going to be fairly decent growth for a couple of years, that means earnings are going to be going up. That means even if interest rates go up and the earnings risk premium comes down, these stocks can grow into their current valuations. If you postulate, on the other hand, we're going to have a recession tomorrow, obviously everything's overpriced. But neither you or I know the future.
No.
And I think guessing too much about it is a little bit of a waste of time.
That certainly is. What is it that you would like to see being done differently? Because you said that while there is a need to correct the imbalance when it comes to the trade deficit with China, but you would have done it differently. You, of course, have said that the tax reforms that the president has announced in the U.S., good thing, which has certainly aided sentiment in the U.S. What else would you like to see being rolled out in terms of measures?
I think the United States is still like this unbelievable, prosperous economy with these huge benefits, and which I've spoken about before. But as policy, we've got to look at other things that we're not doing well. Inner city school education, taking care of the opioid crisis, infrastructure takes us too long to build. There is still too much bureaucracy and regulation inhibiting small business growth. So there's a long series of things that America should also focus on and have good policy. And most of that policy, in my view, is not Democrat or Republican. It's good policy. And unfortunately, a lot of the partisan stuff stops good policy from getting done. And I think it's part of the reason America is growing slower.
Do you think that the elections could have an impact on the way that the economy pans out?
I don't know.
Let me ask you about an issue that you raised along with Warren Buffett, and that was to move away from this fixation of holding out quarterly earnings guidance.
Right.
Have you found a fair amount of support for that thought?
Yeah.
Yeah?
I mean, look, some people argue about it, and they're very particular. It's earnings guidance. Remember, earnings is the tip of the iceberg. You have revenues, expenses, the weather, input costs, output costs. And the point there is it's not terrible. I'm not saying it's going to change the world of long-term investing. We're simply making the point that if you have quarterly earnings guidance, which is hard to hit, a company on occasion, it develops a form of corruption over time. They feel, how are we going to hit our number? So what if you hit your number? Run your company, serve your clients, do a good job, invest for the future. And the result will be earnings. But to think you can guess it every quarter, I think it's just kind of a mistake. And I think companies get their back up against the wall and they have to meet that. And over time, you've seen companies do terrible things to meet it. And that's the mistake. I can change our earnings by a lot any one quarter just by cutting out certain investments or certain marketing expense, and it would be a mistake. But I'd meet my target. My board would be quite upset at me because we don't run the business that way. Just like we don't run the business, we invest in India. India's going to double in size over 8 to 10 years. We cover 120 companies here. We're going to be covering 250 companies here. We do research. I'm sorry, 400 companies. They're going to 800. We do research on 120 companies. They're going to go to 250. I don't care if the economy goes up or down in the meantime.
Where the rupee is.
We're still going to follow that plan. Yeah.
Yeah. So speaking of India and your investments here in India, in terms of hiring, in terms of the kind of growth potential that you see, given the fact that this is one of the fastest growing and currently the fastest growing economy in the world, what is it going to mean in terms of JPMorgan's
think of us as more bankers covering more clients. So we cover a lot of multinationals coming in. We cover a lot of companies here. We do research on 120 companies, and all of that's going to double over the next 5 to 10 years. And it takes a lot of work. You're going to hire people, systems, risk, legal, credit, compliance, loan books, and stuff like that. But that is the plan. So that's one, is how we handle, how we do business here. The second is we have what we call a global service center, but it's fabulous. It's 35,000 people in a lot of cities that do tons of work in security and technology and programming and research, and we're growing that too. And they really are excellent. So we're very optimistic about the future of India.
One of the things that India is betting big on is the digitization of payments. I mean, the financial services industry disruption across the board, not just in India but globally as well. Does that keep you up at night?
No.
No?
I love stuff like that. And look, you can now move money P2P on here. You can buy and sell stocks. If you're a good customer in the United States, for free. We're going to add robo-investing on here. We have to do it too. So everything we do in technology.
So what more are you doing on that front?
Oh, we got tons of stuff going. We have a whole programs, but you can see if you went to the Chase, we can do those things too. So I did meet yesterday with some of your disruptors, and they're doing great stuff.
Potential,
and it scares me a little bit.
Candidates for acquisitions, maybe.
Could be, could be. But they're doing great stuff, and I want to do it too. So we try to use our technology to do a better job for our clients.
What are the specific gaps that you would like to plug?
Well, I think we already plugged the biggest one, which is P2P. Oops, I'm sorry. And there'll be others, but we're going to give people more, we call it a credit journey, more information on their credit scores, they can improve their credit, more financial education to help people who are not, to educate them, to get them to save more money, to think about their retirement. So there's a whole round of stuff that we're building for the future.
So I'll end by asking you, and you can put the mic back on. Okay. At the end of 2018, do you believe that we're going to be in a better place, or do you believe that the vulnerabilities will perhaps, or the headwinds will perhaps overtake some of the good stuff that's happened?
I guess I'm an eternal optimist. The world is going to double in size in 15 years. I don't care about the end of 2018. I mean, I just focus on doing we manage the risk, manage the exposures, worry about things, but we build for the future in every country around. And we just try to manage the exposures from there. So the world is becoming a better place, and as we've lifted billions of people out of mankind, there's going to be another several billion lifted out of poverty, in the next 10 years. And it's a wonderful thing. We just have to make sure we don't get in wars. Yes, absolutely. Jamie Dimon, always a pleasure. Thanks very much for joining us on CNBC-TV18, and we wish you the very best of luck. My pleasure. Thank you.